CNBC TV 18 and CNBC Awaaz present the REIT Connect in partnership with IRA.
Hello and welcome to the REIT Connect, where we tell you all about the real estate investment trusts and how it can be a crucial part of your diversified portfolio. Let me welcome on the show today Ashish Khandelia as well as Amar Mirani. Gentlemen, so good to have you on CNBC TV 18. Now, Amar, we have spoken about the real estate sector and the evolution in the past so many times. How do you rate REIT as one of the milestones and what has it done to the sector?
So real estate investment trust, that's REITs, is nothing but an aggregation of commercial or any yield-bearing properties, asset-backed properties, with a current yield and long-term contract for the future rentals.
Yes.
So it could be in commercial real estate, it could be in data centers, it could be in retail malls, and there could be also in warehousing, and anything which has a similar asset-backed, long-term yield-bearing pattern.
Yes.
So as of now, we've seen about 4 REITs, 3 office REITs and 1 retail mall REIT. It's a big milestone in the overall evolution of this sector because before this, in the last, let's say, since 2005, when foreign participation was allowed and Press Note 2 came in,
Yes.
after that we had about a decade or so or around that period where we had just development play, which is normal real estate development companies accessing the markets.
Yes.
And over the last 5 years or so, we've had these 4 REITs come up, which is a completely different value proposition and offering that has come to investors in the markets. And it's been pretty well received by both domestic, which is mutual funds, insurance companies,
Yes.
the UHNIs, family offices, HNIs, as well as the offshore funds.
Yes.
So it's had a very good track record, not just because of the nature of the properties, which are A-grade properties, and the very predictable and consistent cash flow streams that were promised, but also the nature of the sponsors and the managers
Yes.
has really taken up the bar in terms of the value that it has provided to investors.
Right. Many takeaways on different areas of REIT that you've spoken about, and each we'll delve into, Amar. But Ashish, as an investment destination, how
Right.
do you see REIT as a product?
So Nisha, my feeling is that REIT is a very interesting asset class, especially for a country like India, because we are very heavily towards equities only,
Yes.
and our bond markets are also only restricted to AA and AAA. That deepening of that bond market, which is a big agenda, is yet to truly happen.
Yes.
So to that extent, there is always this issue about what's the alternative beyond equities. And I think REITs in that sense provide a good balance between equity and debt. Their returns are much better than debt, but you don't really should have the same volatility as of an equity market, right? And to that extent, if we kind of look at over the last 3-4 years, because now a couple of our REITs have been listed for that period of time, they have given you 10% plus post-tax yield, which I think is reasonable expectation for this. And that comes along with about 5.8 to 6% post-tax dividend yield.
Right.
So you're getting that kind of a cash flow, which is also better than what you get on an FD or a debt mutual fund, especially after tax neutralization.
Yeah.
So to that extent, I do think it's a very interesting asset class. It does need to kind of be better understood. And there are certain volatility aspects of the market price of REITs, which leads to certain amount of sophistication that you need to figure out the right entry points. And I think those are 1 or 2 points that kind of, if addressed, will further increase the widespread participation. But fundamentally, great asset class because you mobilize a lot of retail money into core infrastructure and asset creation, which India needs.
All right. But in risk assessment, how will you rate it in one word? How high a risk, like commodities, derivatives trading is considered to be highly sophisticated.
Right.
So in a scale of 1 to 10, with
Yeah.
10 being the riskiest, how will you
Right.
scale it?
I would still put it somewhere around maybe 5 to 6, somewhere in the middle,
All right.
because it's not exactly fixed income,
Right.
right? But you can actually look at the dividend yield, and it's not so difficult to decipher the pricing. So if you don't make 10%, you'll still probably get out with 5,
So
6%.
if it's 5, 6, equity is where?
Equity probably has to be somewhere around 7, 8.
Okay, all
mean,
right.
so that's the scale.
Low on risk compared to equity. Also, Amar, then, for the Indian mindset, where we want to invest in gold and have a property. And of course, property investments take a lot of money. A big ticket investment is required. Do you think in some ways it gives an avenue to the smaller category of investors to have a small piece of a real estate investment with a small ticket size as per their savings?
Absolutely, Nisha. So that's one of the cornerstones of the investment in REITs, which is basically the small investors get a chance to have a small fraction, a unit of the entire property or the entire business trust, which issues units to these investors. And therefore, you can have a completely diversified presence across the various assets that are held by the REIT, which is not possible if you were to buy, because even if you were to buy, it would be a very concentrated holding that would
Yes.
that would be entailed, because each of these properties runs into hundreds or thousands of crores. So
Right.
you would have a fraction, not just of one property, but also of all the properties in the REIT, which gives you the element of diversification, which otherwise would not be possible. And you also don't have to deal with the biggest risk that presents itself in this, which is the risk of occupancy. If you were to have a single property and if the tenant were to vacate the property, then you would have to, that entire period would be zero income for you. Whereas in this case, in the case of REITs, not only is it diversified, but also it's being run by one of the best investment managers and property managers across all the REITs. And therefore, the chance of low occupancy is extremely low. So if you look at the current REITs, the occupancies are between 81 and 90%. All the three commercial, and the retail one is somewhere around 98, 99%.
Yes.
Which means that it's a very predictable and very consistent cash flow stream that we're seeing. And the risk is very low compared to what it would be otherwise.
Right. And of course, the tax efficiency
Yes.
that also Ashish spoke about. So these two, aspects are a great combination for the investors, and that could be the pull factor.
Yeah, so on the tax, if I were to just come in,
Yes, sure.
if you look at the post-tax today, look at the post-tax yields, they would be somewhere around 5.5 to 6%.
Yes.
If you look at post-tax. In addition to this, there's the income growth, which is the property rental growth, which is about 4.5 to 5%.
Yes.
Over and above this would be the element of additional properties that the REIT would acquire to grow its own property base. And that, because most of these are governed by leverage, so leverage is also pretty modest and or low in most of these cases. And that presents the avenue for growth in the longer term. So if you look at it, the yields on a compounded basis over a 5-7 year period can go into double digits on a post-tax basis.
All right. So after listening to Amar, Ashish, do you think that, it's a long-term product? It is also because of the capital gains tax benefit to really kick in.
Right.
It has to be held longer to really get the final, returns and the best benefit out of it.
No, that's right. I think REIT has to be a bit of a long-term product, especially where I think it is in the evolution
Right.
cycle currently. So I think the one point I will add to, so I think Amar made all the right points absolutely, because for a retail investor, I mean, it's the best way to own commercial property.
Yes.
You are owning the best portfolio with the best managers, with a lot of governance that is brought in by REIT regulations and all that. I think one element that does come in though is, are we expecting that retail investor to hold it and buy it himself? Figure out at what price he needs to buy it, or is it managed? Like, honestly, like for example, Indian equity markets move from being a lot more direct in the 90s to today by and large driven by managed professional managers, through mutual funds, AIFs, PMSs, and so on and so forth. I think from a REIT point of view, like, I mean, if you look at it, Embassy price, and Embassy is one of the very well regarded REIT, was at 380 2 months back. It is at about 340. Now, as a retail investor, you can get a little bit lost into, was 380 okay, was 340 okay, or is 300 okay? So we do need to kind of create products. It's great that we are doing these kind of a show which creates this education, that if there is a managed product around REIT where people who understand these nuances and they know where to buy, so the return experience of a final investor is going to be better.
Right. So in some way, you're also talking about the corporate governance aspect and the transparency aspect. Now, real estate on the whole has struggled with the perception of transparency for a very long time. RERA, in some pockets, brought in some bit of clarity. Do you think REIT has touched that gold standard in terms of corporate governance? And that is one pull factor which will bring in trust by the smaller investors into the real estate sector.
Yeah, absolutely. You hit the nail on the head. So corporate governance has been something where an area of that real estate needs to scale up. It's happened to a large extent in the last 5-7 years, but REITs, the regulations itself, it really raises the bar on governance. So for example, the disclosures, the norms, quarterly disclosure norms, the distribution norms, the debt, the leverage norms, these are specified by SEBI and in a very clear manner, which means that both investors and the REIT managers and the REITs need to follow, and it's been followed in the last 4-5 years. The experience has been very good, not just in terms of consistent and predictable distributions, but also in terms of the governance levels, the disclosure levels, the directorships. It's really reached international standards on the REITs and the InvITs, but particularly I would say the REITs.
Right. And I would say that a lot of global investors are really invested heavily in this particular space. So it has reached that level of corporate governance. Otherwise, they wouldn't have.
And including on the tax side also. We've had so much evolution on the tax side in terms of the entire swap from the normal holding structure into a REIT being tax exempt, and there was a lot of discussions, and we got a favorable response from the regulator and the tax authorities in the interest of developing this entire space.
Yes.
And then, of course, the entire distributions on dividend and repayment and interest, which was also clarified, thankfully, in the previous budget.
Amar, it's a very, deja vu kind of a discussion, because 12 years back, when first we spoke about business trusts in the country, that's when I started studying this subject. And it took almost 10 years for professionals working at that time to make it a feasible product to come to some sort of a solution. And with each passing budget, tax efficiency had been built in. So it needed a lot of patience to develop an attractive product.
And
a lot of work has gone into it.
Absolutely. And the most recent being the SEZ denotification, which is also a good positive for the sector, because on the whole, the leasing demand is very good. So if you talk to all the 3 office REITs, this is a big shot in the arm. So therefore, their SEZ spaces which were languishing or with low occupancy are now gradually opening up for being leased to normal companies, GCCs, and very many other avenues, which was effectively lying vacant.
Right. So that has opened up a huge amount of potential for this sector. But of course, with so many global companies looking at India, setting up place in India, they're looking at the growth potential over here and want a piece of that, and therefore the Indian offices. That really sprung up in the last decade in India in a big way. And some of these offices are those high-end offices which appeal to these big companies, global companies in particular. So Ashish, it's also an experience. It's a high margin premiumized product which is being rolled out as an investment class as well.
That's right. I think the quality of occupiers, I think in India, it has always been good, because India always started more as a knowledge economy and, exporting knowledge in content. And that has just been going up in that sense, and even if we look at typically where our REITed assets are actually leasing, in terms of per square foot and all that, I think they've started crossing that $1 per square foot per month kind of a mark, which has been the standard for many, many years. Some of the assets in there actually are now at $1.2, $1.3 per square foot per month. And that has been kind of a pseudo hedge. I think it has also provided currency hedge in a operating way to a lot of foreign investors, because, any foreign investor being part of Morgan Stanley and KKR earlier, we have seen that this currency hedge in making any Indian investments has been a big big elephant in the
Of
room.
course.
And in case
Forex,
of REIT or office investment, there was this natural hedge because the underlying operating income used to move along with that. So yes, I think there is premiumization going on. I think our operators, our manufacturers of these assets are now very high quality. Like, people who have done REITs or a lot of asset or stock that sit outside of it is still very high quality.
Right.
And we still are talking on only about 10 odd % of grade A office stock which has been REITed.
Yes.
You know,
So yeah, let's talk about the growth potential now. You're saying that only 10% of the grade A offices. Now, in India, in several places like Delhi, Bombay, the address matters a lot, right? People take pride in saying that come and visit me in my Express Star building or CJ House building, and it comes with also that confidence that we have paid a huge amount of money for that real estate, or we are paying a huge amount, or we have the ability to pay a huge rent and having an office there in a swanky place. So, Amar, when we talk about the growth potential, the demand, as well as the development capability, so that the REITs can expand their portfolio, because growth is not just about rental income growth and the unit price growth that the investor gets, but the portfolio of a REIT also grows in its assets so that they have more generating assets. How is that particular aspect of growth looking?
So growth comes, like you absolutely correctly mentioned, growth is in 4 forms. First is obviously rental growth, which is organic and which is priced in the agreements. Second is the occupancy growth.
Yes.
Like I mentioned, occupancies are in the 80s today, which is amongst on the lower side compared to what they have been on an average in the last 5 to 7 years. So there is room for that growth. So that's the second element. Along with that is also the physical occupancy in each of these commercial offices. In the COVID period, it came down drastically, but now it's touching 70% roughly in all these 3 office REITs. So that's the occupancy element. The third is to do with the element of additional volumes coming in. So effectively the REIT buying additional office blocks. It could be buildings, it could be commercial office parks and so on. So that is something which is what is happening now with the 2-3 office REITs. And the good thing that works for them is that their REIT is listed, so that is a currency that they can use for acquisitions.
Yes.
And also the leverage levels are on the lower or the modest side. So that is something that they can easily use for growth. The fourth element is to do with interest rates. So on the interest rates, we are somewhere closer to the top than to the bottom, obviously, and the entire interest rate cycle is to play out. And that we've seen a very strong correlation or inverse correlation between interest rates and the cap rates, as they're called, or the capitalization rates in real estate, commercial. So as interest rates were to come lower over a period of time, and I'm not saying it will happen soon, but whenever it happens, gradually we will see a stronger interest in REITs from all kinds of investors, because ultimately it's a yield-seeking product, be it retail, be it the foreign, be it Indian. So therefore there will be a stronger interest, and therefore that is another trigger for growth in this sector. So these are the various elements how REITs growth would occur over the next few years. And some of these have kicked in, some have yet to kick in. So there is still a good runway that exists in front of us.
Right. So interest rate is one of the very important macro factors which impacts the REIT scenario, and interest rate cut is something that everybody is waiting for, and REIT will also be a beneficiary of that. But Ashish, it's a product which has the equity element as well as fixed income element.
Absolutely.
Now, for an Indian mindset, when you invest in stocks, you look out for big companies to give dividend, which is not predefined. But in this particular product, the company has to mandatorily distribute 90% of its cash every quarter. Now, in this kind of a scenario, do you think that it appeals to the Indian middle class and the mindset?
So I think that's a very interesting question, and so that's exactly the right balance we need to talk about. I think so it has a fixed income element, because by governance and by regulation, you have to distribute most of your income, right? And therefore, most of our REIT stocks, if you would see on a pre-tax basis have been, trading at between 6 to 6.5% dividend yield, right? And on a post-tax basis, it is just 5.8 to 6%. Now, one thing that does happen, which is different from India versus if you look at Hong Kong or Korea and all that, the gap between the yield that we are getting on our stocks here versus, let's say, on the government bond is not that high, right? And therefore, unless you have that sophistication to understand what capital appreciation I'm going to make out of it, just the dividend yield will not become exciting enough. And that's where this nuanced understanding of REIT and therefore managed product, to my mind, are very important, right? Because when you think of it as a fixed income product, then today people will say, okay, we are at the top end of the rate cycle. And if I'm getting my government bond at 7.2% with a certain amount of appreciation in that bond, I might hit 9 to 10%. And why should not I then go buy the bond versus this? The other very interesting, so I think the larger family offices, ultra HNIs who have larger portfolios to allocate and they will have multiple asset classes, I think the REITs will fit in better. For a retail investor, I think it is still nuanced. The understanding of the tax treatment, what is interest, what is debt amount, what is dividend. So it is more nuanced. Understanding of capital appreciation is a little bit more nuanced, right? So to that extent, I think you do need to figure out how to increase retail participation as opposed to foreign. The other thing also that has changed, purely talking about investors' interest, is when we started, I think the interest by foreign institutional investors was very high. But we are in a very different interest rate regime now. I think the interest rates in the West are very high. And if I'm offering a total return of about 10% with a 4% dollar and I'm at like a $6 or something like that, versus their own yields on the treasuries are all between 4 to 5. Between India as a country and all that. So I think that has waned off, but the domestic interest is increasing. It needs to increase a lot more.
I think the traction by the retail participants and more volume play and transactions on the exchanges is one thing that can bring in that capital appreciation also.
And if you look at the sizing, just touching upon that, today we are at $10 billion market cap on the REITs, across these 4 REITs, right? And about 100 million square feet being managed, a little bit more, like close to 110, including some of the developmental in-place positions that will kick in. If we go from 9-10% to, let's say, 30-40% in Class A, our Class A is about 800 million, growing at about 5-6%, so it will be probably 1,000 million square feet, right? So if you extrapolate that, in a 5-year time frame, you can be about a 50-60 billion market cap, which I think is a sizable asset, but I think still my feeling is there has to be a longer room. Like as an overall economy, we are a 5 trillion market cap, of which 50-60 is still about just 1%. So how do you really get active managers to focus on, like in US, you are about 1.4 trillion of a 25 trillion. So you're still about 6%. Versus on a 5-year projection of, let's say, 1. So I think there's a lot of room. We got to do a lot of work to make sure
it is at a nascent, phase right now. And of course, globally, there are residential REITs also. And India hasn't even touched on that one. So, Amar, we talked about the office space. Now, we have one REIT with malls right now. Which are the other categories which are really making their way into REIT? And do you find their potential also as large as the office space or maybe bigger?
So if you look at the various elements of yield generating instruments, so office is the biggest. So if you look at the office overall sector, in the top 6 cities itself, the grade A office stock is about 830 million square feet. Valued at about $140 billion, out of which 10 billion is REITed today. Another 80-90 billion can be REITed. The remaining is strata, so I'm not counting that. So 80-90 can be REITed. So that's commercial office. The next big sector, if you look at retail malls, retail malls is about 60 million square feet of grade A mall stock. About 102 grade A malls in the country. And this is across all cities and towns. It's not just top 6 because it's a consumer-driven sector. Out of that, perhaps the biggest one is listed. maybe a couple of others over the next few years can get listed.
Yes, there is a pipeline.
Yes.
Yes.
So that is the second. Apart from these two sectors, warehousing, we have seen one InvIT. There is a lot more action happening there in the warehousing sector because that is a beneficiary of many aspects coming together. GST, better connectivity, better growth, manufacturing, China plus one. So all these are contributors to warehousing, and we are seeing a lot of action in that space. So we have seen one InvIT, and possibly a couple of others in the next year or two should happen. Apart from these, there is a lot of other avenues, like, for example, hostels, co-living, data centers.
Yes.
All of these may not be REITed today or may not have REITs at this point. At this point, it's more transactions at platform level that are happening between these platforms, private equity funds, and other forms of capital,
Yes.
in anticipation of a REIT taking place 3, 4, 5 years later.
Of course.
So over a period of time, we will have a lot more sectors. So if you look at the US, for example, jails is a sector which is REITed.
Yes.
Of course, that's quite some distance away, but all kinds of income generating, contract driven, asset driven sectors, asset backed sectors are amenable for a REIT.
Yes.
So just taking off from what Ashish had said earlier, we are a $5 trillion market cap economy now. We have only 11 billion or so of REIT market cap. So that's less than 0.25%. Singapore is at 12%. US is at about 3.5%. We have ample room to grow. We are just at the beginning now.
And also SEBI is of the view that REIT and InvIT market can be as big as our own equity market in a few years. So that's the thrust from the regulator also.
Absolutely. And one additional element which I would like to bring in is that India is a high growth market. The GDP growth, the GDP per capita growth, and it's a long-term story and long-term play.
Right.
REITs, by their very nature, have two components, yield and growth.
Yes.
Yield we all understand, we've spoken about. But growth is something that has yet to be fully priced in.
Yes.
So if you look at growth, which is all these elements, I think we are still not priced in the element of growth into the REIT pricing. That is still to play out.
Right.
Because the reason I'm saying that is because the yields at which they are available today are around what the G6 are. So where's the element of growth priced in? So it needs to be looked at carefully by investors, and I'm sure with investor education and more understanding of this sector,
Yes.
and more REITs coming in and getting listed and traded, that is bound to happen over the next few years.
You know, very interesting point here is that, Amar, you know, the Indian mindset understands this kind of a product play because a lot of people want to buy property and rent it out as an investment, right? That is in the psyche of our savings and investment mechanism. And now I hear what is going to create a bigger business or a bigger understanding of this particular space is also fractional ownership as well as SM REITs. And many people on a private basis have started working towards it. And there is a lot of attraction towards this space. Now, a much better corporate governed company, which is a listed REIT, could appeal to people once they have tried and tested in smaller ticket, assets, and they get a flavor of what it can really provide in terms of returns. So I think the market is expanding and the education is growing with different kinds of products in different categories also coming in. But final question to you, Ashish, if a new IPO comes in the REIT, and I do imagine that there is one just raring to go ahead and a few lined up in the next couple of years, how would you look at it? And overall, how would you really position REIT in your own portfolio?
So that's a tricky question, especially, I mean, see, honestly, it depends on what's your own risk appetite. But to my mind, there's one interesting aspect that's starting to play out in India, which in a way competes with REITs a little bit.
Yes.
You talked about fractionalization, there is an element of that. But I think private credit as an asset class is emerging, both real estate, non-real estate, right? And we, in our own way, have experimented with it a little. So one thing that you got to kind of look at is when you're positioning this in your portfolio, if I'm buying for growth,
yes,
sometimes you want to buy equity.
Yes.
Because, given our growth economy, we are going there. If you are buying for yield, you want a better yield. And that's kind of balance. I mean, REIT somewhere brings in that balance.
Yes.
But I think whenever I look at my own portfolio, I am always looking at equity versus debt. So if I have to go for growth, I would go for equity and otherwise go for high yielding debt.
Yes.
So I think that's kind of the thing. So personally, I am doing less of REIT right now
Yes.
and focusing a little bit more on private credit for non-equity alternatives.
Yes.
But that's the thought. But I think there will be enough and more takers who want to be a little bit lower on the risk curve and go for REITs.
So the ones who have a lower risk appetite would go for REITs, you're saying?
I guess so.
Okay, so those who want a stable cash flow coming in and not
With the
looking
asset
at...
backing there, because private credit does have an element of more aspects going on along with that.
Yes.
So that I think is the thing, which will play out.
No, thanks, Ashish, for giving us your candid summation of where REITs stand,
Right.
according to you, as an investment destination. Amar, any final words on this?
So I think REITs, we have seen a good amount of evolution and a favorable framework that exists today. I think a few more things to make it even better from here for investors and for the overall growth of this entire space.
Yes.
Obviously, with more investor education, and thankfully we have active research on all of them, and investors do understand this and the nuances, some of which we have spoken about. But I think the element of trading needs to really ramp up. That is something which we've been talking about for some time, and I would like to dwell on that perhaps. So today, if you look at it, the overall trading that exists is on the lower side for all these four REITs.
Yes.
So I think it's somewhere between 0.1 to 0.2%. The average trading volume being 0.1 to 0.2% of the free float market cap,
Yes.
which is about 2.5 to 3.5 times less than normal BSE 500 companies. That is something which, if taken care of, obviously from a regulatory point of view or from AMFI point of view, that can really increase the extent of price discovery because trading volumes will be higher.
Right.
That is something which I'm sure will happen with, like you said, more listings taking place, and we discussed more listings. So there'll be more investors, better understanding, better comparisons, because there are only 3 office REITs today. So 4, 5 will lead to a better,
Yes.
wholesome, all-round growth in understanding and availability of stock.
Right.
And the second, I think, is to do with taxes. While even now the element of taxes is well taken care of, but from a long-term gains perspective, it is still 3 years.
Yes.
If that can be harmonized with either the various, either equity shares being 1 year, or even if you look at core real estate,
Yes.
it is 2 years,
Yes.
whereas this is 3 years.
Yes.
So that again would lead to some degree of more interest amongst the listed market investors.
Those lobbies are really going on, and probably equity classification also, that can be another day's topic of discussion. But Amar, I would say that all of us have seen the equity market. When I joined CNBC 20 years back, it was a very small market and mutual funds were unheard of. Today, you see the kind of SIP and mutual fund inflows that we see, and see where the market is above 23,000. So a lot of investor education and a lot of evolutionary changes have made our market so big, and any new product takes a little time but then reaches there. So this is a good space to keep a track of and really chart out its growth trajectory and probably ride the momentum as the breakthroughs really happen. So that's how I would look at it. But thanks so much, Amar, as well as Ashish, for giving us a lot of deep insights on how real estate investment trusts work and what is the potential challenges as well as suggestions for future growth. Thank you so much for joining us. And thanks to all our viewers for tuning in to understand more about REITs. It's a wrap on the REIT Connect. Thank you.
CNBC TV 18 and CNBC Awaaz present the REIT Connect in partnership with IRA.